Hi everyone, it's been a few weeks since we spoke, so here we are again talking about the SBI Alternatives business. I'm Sumera Apti, and with me I have Gaurav Mehta. He's a Chief Investment Officer of the SBI Alternatives business. So Gaurav, it's been a bit of a tough going on the ESG PMS, and largely it's because we have seen that the market has also been favoring value over growth, right? Are there some sort of adjustments that are needed or that you're looking at? How are you looking to navigate through this tough time while still remaining true to the ESG principles?
Right. So the index has had a great run over the last year. The portfolio has done fairly fine in absolute terms. But you're right that in relative terms, we have underperformed over the past year or so. Now, is it a function of value, growth, and those styles sort of changing favors with the investors? We don't necessarily tend to think of our portfolio in those terms. What we are essentially trying to do is to create a basket of 20-25 good businesses that we want to own for the next 3-5 years, maybe longer. What we are very focused on is to buy these businesses at the right valuation. In general, we are looking for companies that can grow at a much higher clip than what the index earnings do. Also, our portfolios tend to be focused on high ROE, they tend to be very low on financial leverage, and overall, these tend to be very low beta portfolios. But for doing all of this, am I overpaying? I don't necessarily think so. So, if you look at the PE of our portfolio today, it is somewhere around 23 times on the current year earnings. The Nifty would be between 20 and 21. So it's not a materially, different PE number that you're looking at. And as I said, we are looking at higher earnings growth numbers, right? So if you were to sort of roll forward to the next year or the year after that, you will see that both R and index PEs are actually converging on a forward basis. So I don't think it's so much to do with us buying expensive stuff, which is usually what people tend to mean by quality, and we're not sort of at the other end of the spectrum of value trade, so to speak. But I think what also tends to happen with portfolios like ours is that as earnings keep coming through, the portfolio delivers, and it delivers at a certain consistent clip. But because the beta of the portfolio is low, and the second most important aspect is that we run very high active coverages versus the index. So the overlap between our portfolio and the index would be maybe 20% or somewhere thereabouts, pretty low. What that essentially means is that over short periods, your outcomes are very different than the index's outcomes, because you're running very high active coverages, and also because your beta is low. Whenever there's a sharp spurt in the market, you tend to not sort of move as much. But then the flip side is also true, that whenever there's a sharp downtick in the markets, you also sort of tend not to fall that much. So I think we tend to look at our portfolios as 3 years investment horizon portfolios, and with that as the time frame and with the quality of businesses and at the valuation that we bought them, we don't see any reason to be worried at this point in time. And which is why I'm here to answer your question on any course corrections that are needed. We don't think that there is any need to change the strategy as such. That said, we are always nimble. Whenever we make mistakes, we accept those. We move out of these ideas. We are always on the lookout for new attractive opportunities. So I think that's an ongoing process. But what the index has done over the past year, specifically over the last 4 odd months, has very little bearing on the strategy or any need for changing it, so to speak.
So basically what you're saying is that because there is such a low correlation to the index, that don't always look at it, just in relation to the index, right? Look at the performance on its own steam as well. But there is this perception that ESG is losing its relevance because we have seen such an outperformance from these so-called anti-ESG stocks, right? So how do you look at it?
I mean, it depends on how you are thinking about ESG, right? And I do agree that there are certain funds which would be thinking of ESG as these themes around, energy transition or green hydrogen or green energy and so on. For us, at least in this fund, that's not the mandate, right? What we are doing essentially is that we are throwing out what is non-ESG in our view, and we make some sector exclusions, for example, tobacco, fossil fuels, alcohol, etc. But these are very small sectors that get excluded, beyond which almost every other sector we are fairly comfortable to invest in, including, let's say, something as controversial as chemicals. Because in chemicals, you see there are certain companies which are following the right effluent treatment practices, good sort of employee safety environment and so on, but there will be several other companies that are not doing this. So what we essentially do is from all the other sectors, we remove the bottom one third of the universe on ESG scores. So, what the investor eventually gets investing in the ESG fund is a very well diversified sector mix. Right? So these are companies from across sectors, and again, we tend to buy 20-25 companies, no more. So we are very concentrated, but you get a wide sector representation. You're not sort of exposed to a certain sector or a certain theme like green energy, etc. Because once you are exposed to a certain theme, then obviously there tends to be a cycle, and as you're right that sometimes those themes will be in vogue, sometimes they won't be. But for us, ESG is about sustainable investing, and the way we do that is by removing the bottom one third on ESG across sectors. For us, essentially, what also tends to matter is to go beyond E. Right, ESG is not just about the environmental aspects, right? How you're treating your stakeholders, how you're treating your employees, governance, right? All of that is very important if you're thinking of long-term wealth creation from equities. So I think we tend to look at ESG in a more holistic fashion rather than playing or skewing ourselves in a certain limited niches or sectors. And to that extent, we don't think that our approach is that sort of cyclical or thematic in nature. We think it's an evergreen portfolio that should deliver. But as I said earlier, the long-term focus is something that we tend to be very focused on. We are not thinking of earnings today. We are thinking of good earnings, but sustainable earnings at the same time. And to that extent, as time elapses and as those earnings keep coming through, the portfolio tends to do well. But beyond that, it's a well diversified portfolio.
All right, Gaurav, thanks so much.